Howdy, Jacob here. Today we're looking at Celanese Corporation in the chemicals industry, just under 16 billion market cap, just over 25 billion enterprise value. So you're looking at a bit of net debt here. They are a chemical and specialty materials company that manufacture and sell high performance engineered polymers globally, founded in 1918 out of Texas. So it's been around for quite a bit. You're looking at about low to mid single digit revenue growth here, with gross margin and operating margin both relatively flat from 10 years ago. They do pay a dividend. It's pretty hefty on the yield side, about 1.9, better than market average. But in relation to earnings, it is very reasonable. We'll see what it is in relation to free cash flow. Return on invested capital, very solid as well, historically in the double digit. Most recent year, 9%, but very solid. Balance sheet shows 1.8 billion cash on hand, 1.4 billion short-term debt, 12 billion long-term debt. So we're looking at a lot of debt here. What happened here? Acquisition of about 6 billion. So they went into debt to fund that. Okay. So right here we see a 10.5 billion dollar acquisition, which was funded through 10.8 billion dollars in debt. Okay. That's not fantastic. The dividend on a free cash flow basis is very reasonable, less than 30%, about 20% of their 5 year average free cash flow there. So that dividend's not a concern of mine. They bought back a lot of shares until this acquisition happened, and now they're going to be focusing on debt reduction. Ugh, that sucks. So it doesn't look like this acquisition did really anything to free cash flow. I mean, it did a little bit, maybe. So we don't know whether this is all organic or the acquisition, but I mean, there was a $500 million increase in cash from operation, and then a $200 million increase of property capex. So you're looking at about $300 million. I mean, $300 million of free cash flow extra for $10 billion. To me, that doesn't sound like it's a great acquisition, but I mean, it hit the top line. I'm sure that's what a lot of people are caring about. For me, I want the company to be hitting free cash flow. I want to be hitting earnings per share. Um, so for me, right now, I'm going to assume a lot of capital expenditure goes towards, or sorry, a lot of cash flow operation goes to debt reduction. And again, we see that here, $1 billion of their 1.3 billion going towards debt reduction. I mean, it sounds like for the next couple of years, with their debt being 10 times their 5 year average free cash flow, they're going to be focused on over 50% of capital allocation going towards debt reduction. So, I mean, when that debt comes due, they're going to have to refinance. It's just going to, debt creates problems, especially when you have over, if you have 10 times your 5 year average free cash flow in debt, that's probably due in the next 5 to 6 years. That's going to be a problem. And so that's going to have to go into my assumptions here, and it's going to have to go into your assumptions when you do your own analysis. So for me, I think they can still grow with inflation, but I mean, I'm not assuming any acquisitions here. I'm not assuming anything else. I think they can still roll with 17, 50% margin without any acquisitions, nothing there. Share change, stock-based compensation is 36 million. Not really doing any debt, not really doing much there. So just stock-based compensation as share change. Terminal PE, I mean, again, their enterprise value is still going to be way higher than their market cap at the end of 7 years. So maybe we'll do 10, and then the dividend, not increase it, but just keep it flat. Well, I guess they've increased it to 3%. I could probably increase it with 3%. I'm fine with that. So it stays at that 20% payout. This is assuming 60+% goes towards debt reduction, and at the end of the 7 year period, enterprise value is still probably going to be about $5 billion greater than their market cap. But as of right now, feel pretty comfortable with these assumptions. We're saying the stock price needs to fall 41% before you get the return we're looking for here. Interesting company. If I did more research on it, I would definitely look into that acquisition. I would love to see if it were a public company, love to see what its free cash flow earnings were prior to buyout. But um, as of what I'm seeing right now, it doesn't look like the most advantageous acquisition. It didn't. It looked like it brought a lot to the top line, but not really much to the bottom line here. So for me right now, I'll just be waiting until it gets to a more attractive price and review other companies in the meantime. So I hope you enjoy the video and have a great rest of your day. Thanks.